Welcome to the Tesla Economist. Please hit the thumbs up and remember to subscribe. You can follow me on Twitter and talk to me on Patreon. Alright, not the prettiest day out there. I think this is what you call a bloodbath, at least for some of the stonks. Rivian down 20% in a single day, and they're about to announce their earnings report, which could send it down even further. And it wasn't just the EV industry that got hammered. Palantir was down over 20% too, which was already down about 70% from its high towards the end of last year. Some stocks are getting crucified. Netflix is even trading at a P/E ratio of just 15. Yes, we're seeing blood in the streets. The markets are crashing. Bitcoin even got crushed all the way down to 30. That's a serious credit crunch. But there wasn't much else you could sell on the weekend. Is this time for a buying spree? Everything's on sale. For me, as tempting as Netflix and some of the others may look right now, my investment strategy is concentrated knowledge and investment. Invest in what I know and make sure I know it well. I'm fortunate enough to have enough invested in Tesla to retire and justify my time concentrating on that investment. For me to invest in something else would result in an opportunity cost on me learning more about Tesla. This other investment would also be small in proportion to my Tesla investment. The result would be I'm not allocating an equal amount of time to managing each dollar. E.g., if I had $1 million in Tesla and $100,000 in Netflix, then I'd be able to justify my time better spent on learning about Tesla. My current strategy is not any sort of diversification. I just want to see where Tesla goes and see if it makes me rich or super rich. I do hold some Bitcoin too, but that's not like stock that you need to follow. I understand monetary policy and the history of money and finance enough to justify my Bitcoin investment and keep it relatively passive. So despite all these other bargains showing up, I'm still only tempted by Tesla. If I ever was going to diversify my stocks, Google would be the next one I consider. I love that business model, and having worked in e-commerce for 25 years, I know that industry. Okay, so I'm a concentrated investor and concentrate in Tesla. Throughout the entire time of this channel, I've not deviated the course once. I've been focused on my mission of accumulating as many Tesla stocks as possible. Anyway, we know why the markets are acting like this. It's the Fed and the concern we have about them raising interest rates further to combat the inflation that has occurred from their gigantic spending during COVID. This is the invoice coming in for COVID. That's right, the invoice goes to you, the taxpayer. Unfortunately, as much as the government may try, those printing machines are not actually magic money-making machines. Governments can't create money. It's similar to how the law of conservation of energy states that energy can neither be created nor destroyed. Except in this scenario, government are actually very capable of destroying money as well. Anyway, the invoice is due and the government are trying to work out how to pay for it. It would appear sending that invoice straight to the market is going to be too extreme. The market can't handle this. There doesn't seem to be enough liquidity in the economy, so it will kill the market and will likely result in another credit crunch. All of this is due to inflation. The inflation that was caused from all that government spending during COVID. We're now left with the economic disaster from COVID and trying to navigate through that now. Inflation means all money becomes worth less. It loses purchasing power as everything else is becoming more expensive. Look at cash as an asset class. During inflation, cash crashes. To counteract this, the government simply make money more valuable. To make money more valuable, it's the same as making a stock more valuable, increase its earnings, or as we say with money, increase its interest rate. Then money becomes more valuable as it is offering a better return than it was before. Investors then sell stocks as a result, as the opportunity cost has increased due to money becoming more expensive. Then the economic effect of people being less reluctant to purchase and more motivated to save due to higher rates. Except the levels of inflation we're at today, well, it's going to take more than a slight interest rise to keep it under control. Now, though it's going to take more than that, the issue is the more the governments raise rates, well, the more pressure it also puts on the markets, stock and property. Therefore, there is this dilemma governments face. They need to keep inflation under control, yet also not crash the markets, and they're in a very precarious spot. However, it doesn't stop there, as the governments also have a huge amount of debt due to all this money printing to get us through COVID. Well, governments also have to pay interest on their debt too. If rates go too high, then there'll not be enough government income to cover the interest, along with all the other government spending required. And this is where we are, the dilemma. Monetary policy is the main way they will control this, through interest rates. I'm not sure if fiscal policy will even come into play. This was meant to be used to control modern day monetary theory. Right, MMT. We still haven't seen the worst of that yet. What if China also starts to crack more with their MMT? MMT is nothing more than Keynesian economics on steroids. It was doomed from the start. I think this can even be explained with something as basic as broken window theory. So government really only have interest rates and fear and manipulation too. They're going to have to bluff and practice some serious poker faces. They are testing the market's reactions. Do they raise rates, crash the economy, Lots of people lose their houses, jobs, etc. Government bond rates get too high and governments can't afford their interest, so they print money to pay for the interest, and we end up with more inflation and possibly hyperinflation. Or government don't raise rates as extreme and inflation keeps going until we hit hyperinflation perhaps. This actually may even be a more difficult job than the legacy autos trying to make a profit with EVs. The Fed somehow need to balance this perfectly by keeping some control on inflation without crashing the markets. Look how much the markets crashed today, and we aren't even at 1% interest yet. We have seen rates as high as 20% to try and mitigate inflation like this in the past. If this is how the market reacts at 1%, can you imagine 20%? Right, it can't happen. Basically, government have a really big fire to put out, but they don't have enough water to do it. Water being room to move on interest rates. So will there be a recession? I mean, surely there has to be one coming, but what will happen first? Where is it safe to keep your money? Well, there is a crash, then you want to be in cash so you can buy up all these cheap assets on sale. Sure, great, that's contrarian investing. It's just that, what if the market inflated massively first? What if the Dow Jones shot up to 50 or something crazy this year before it crashed? Yes, very likely there is a market crash on the way, but often before a crash is when the markets jump at the highest. And perhaps with the threat of hyperinflation, the markets might jump again due to the dollar being so weak. For example, similar to 1971 when Nixon took the dollar off the gold standard, everything inflated, or dollars crashed essentially. Perhaps the dollar will crash first before the market crashes. In other words, just because there is a crash coming, it still doesn't mean you can time it or have a good place to put your money. Some people might be jumping to gold, a good solid store of value, except if it's a credit crunch, then that would drop somewhat too. And who's to say that this time, perhaps investors will seek Bitcoin as a store of value instead of gold? To be honest, it's pretty scary working out where to put your money, given the fact we could see a huge crash, or hyperinflation, or both. As good investors, though, we should prepare. We can't predict the future, but we can prepare for worst case scenarios to make sure they don't catch us off guard, and make the necessary hedge if required. I was talking about preparing for an event like this last year, and putting together an insurance policy. I was looking at shorting legacy autos like Ford and GM, and I was going to put together this insurance policy after one more ride on Tesla options, but that didn't go so well. However, in the meantime, I managed to sell off enough Tesla options at a profit to cover my house mortgage payments for the next 3 years, which means I likely won't lose my house. Well, I guess I should say I likely won't have to sell any Tesla shares to pay for my mortgage. So I have cash as insurance anyway, and I don't think I'm going to buy any put options on QQQ or anything like that. Anyway, I have some security, but what about investing? Well, as I've been saying for a while, this Q2 isn't going to be great, and I was just referring to Tesla internally, but we have all these major macro issues going on right now too. It could get worse before it gets better. I said on the last dip that I was going to wait for a bargain, not just a dip, and I expected it to drop below 800. Well, it did, and I bought an option then. I'm planning on buying more still, but I'm going to do this very slowly. I think I have plenty of time to get some bargains right now, and the fact the options last until mid-24 reduces the risk for me a lot. I mean, there's a good chance that the Fed could just reverse course on this, like they've done every time since the 80s. Pause rate hikes, inject liquidity, and let inflation run hot. Right now, the market looks like ugly times ugly, and this is where you find out if you are actually a good investor. Do you have the conviction to hold through tumultuous times, despite perhaps being down 50% on your holdings? Are you going to be able to hold on to your shares still if the economy turns, you have less income and higher expenses? History shows that if you get out of it, then it always recovers. Well, except for Japan in the 90s, but this is not some crazy bubble we're in. You may not be able to catch it at the bottom this run. You might end up being down a bit, but don't put too much pressure on yourself. You can't win all the time. As long as you make it through this round, you can keep building your position as you go on. You see, being a good investor is not just about buying the right stocks, but it's about holding them through the difficult times too, and even buying in those times as well. Make sure you've not over-leveraged yourself too far. The way to lose money in investing is having to sell in the bad times. Investing is like swimming. Sometimes the tide is against you, sometimes it's with you, but just keep on swimming, and over time you will be ahead. I will do an updated video of how I think Tesla will perform in a recession too. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.